the business plan that I'm discussing, no one seems to know about it.
Now, there's a reason why. And it goes to the other side of what you do, which has a lot to do with psychology and walking people off the ledge. Discomfort makes for poor decision making. Humans don't like to be uncomfortable. They've been comfortable their entire lives, and now there's discomfort, and they don't really know how to act. And there is a specific strategy that you're stating that you need to implement when you're acting appropriately.
What's up, everybody? We're back, but we're back in a different place. Confronting the Impossible is a podcast that I run. It's a show about real estate, the good, the bad, and the ugly. We have a special guest today at the Real Deal event at the Metropolitan Pavilion, but none other than Eric motherfucking Brody. How you doing, E?
I'm doing amazing. And Leo, what better place for you and I to talk, although we talk all the time, than in the middle of the Real Deal event?
Where it's at.
I can barely hear you, but this is where it's at. If you and I are communicating, then this is where you want to be.
Let's talk about the market. Let's talk about real estate. You know, I've been speaking to a lot of people here, and they're saying that the market is getting better. I mean, I don't believe that, E. I mean, that's not what I'm seeing. What are you seeing? Let's talk about it.
Well, I think it's really important for our audience and everyone here to understand. So first and foremost, most people don't understand where you sit in the real estate ecosystem, right?
That's right.
And I think that's super important. So what you don't see, and you do see some front page news, but there's a lot of distress within the marketplace. You hear about it. We hear about it from a space of capital trying to come in to buy those deals.
I'm interested in that. What are they feeling? What are they thinking? Talk to me about the people that got the money. What are they seeing and what are they going after?
So first and foremost, that is what we do, right? Can we identify all capital up and down the cap stack in the United States of America and around the world that wants to then deploy capital into America's real estate marketplace? So that's why this is an important conversation. And they all want the same thing. They want mitigated risk with high returns. And if they perceive that they can do it, they're going to take less risk. So imagine you want to do a new deal. Why should they do a new deal when they can look at distressed assets, assets that are underwater, that are undercapitalized, come in with that capital, sit in front of the existing equity without doing any of the work and make money? Like, why wouldn't they?
Yeah, but do they realize that there's liens, there's taxes, there's people dying, there's old people, like you can't sell, and you have restrictions on that. You have mezzanine debt. Do they understand those consequences? I mean, getting into real estate and just purchasing for purposes of investment is a different thing than saying purchasing when it's for distressed investment. Distressed investment is just that. It's in distress. It presupposes that you have to work with your capital. Am I correct in saying that when you're doing a straight multifamily investment that, you don't have to necessarily look about what is wrong? You have to go through ordinary diligence. But when you're going through distress, you're doing something more than that. You're speaking to the borrower. You're speaking to the mezzanine lender. You're talking to the vendors that haven't gotten paid for a while. You're looking at the deed restrictions and why you can't transfer it right away. You're looking at the taxes. You're working with the city. I mean, the guy is bankrupt. You have to restructure that. So are these people that got the money, are they paying attention to that or no?
All right, so that's a great question. So first and foremost, let's break it down. Let's say that capital is a fund manager. They compiled the capital. It sits somewhere. They're coming up with a strategy of how to deploy that.
Okay.
What you're then stating is, are they then direct to the asset? And the answer is they're not direct to the asset. What they look for are asset managers. They're looking for those that are expertise that need capital. So first we were talking about a thesis, which is where can we deploy capital into real estate in America today? And we're saying distress. Then they're looking for those that are asset managers, the ones that are dealing with all the issues that you're talking about, that understand how to navigate that so that they just ask for the capital in the moment where they can actually deploy it.
Yeah, but I have some use for you, okay? You're talking about limited partnerships. You're talking about fund managers. I have about 12 matters right now. One of them being a major Boston property where we're representing limited partners in their loss of a big Boston building. Then I have another family office that has approached our firm that's talking about these individuals that know how to run real estate on the ground, and they're committing fraud, malfeasance, mismanagement. Right? So like these fund managers are caught in a very problematic situation.
You are right.
I know.
You're 100% right in that the asset managers are the same ones who are syndicators who are in trouble. Put them aside. And I agree with you 100%.
Right?
But remember, you have a timeline. And you could probably tell me what that timeline is from the time that a client comes in who may be an operator in distress and the time it's going to take to a resolution. That is a timeline. That timeline for you started 2021, 2022.
Right.
As some of those matters are now being resolved. And when they're being resolved, it's recapitalized, right? Something's got to be done there. So they're like, all right, Leo, the deals that you have, we'll put a pin in that bad boy. But we're going to go after the ones that are coming to the near the end of the process for you of saying getting rid of the liens, foreclosure, handing the keys back.
So it's about prospecting.
100%.
So it's about waiting. So let me tell you about the process, okay? Minimum for restructuring is about 9 months to 36 months. That means you're with the client, you're with the project, you're with the property for at least a year on average. Due diligence time for a multifamily, hotel investment, warehouse, data center, at the max, it's about 60 to 90 days. And if you need to get into litigation, max, it's about another 30 days or 60 days. Do you guys know that it's going to take at least 9 months to 36 months to restructure an asset?
It's not only that, though. So there's a few different things, and I think it's important that we talk about it. So first is, if they're in the game with you, the new capital, the asset manager, the new one, the one that they believe in, right? Maybe they have that opportunity to capitalize it. They got to be in the game with you to know that there could be a restructuring there. But more important, and I found this to be fascinating because I'm now dealing with special servicers everywhere, the professionals who know what the outcomes could be. Tell everyone, what is the outcome of distress for that principal or that syndicator? What are the different routes and the outcomes that are possible?
I'll explain to you. So a lot of people believe that just because a borrower is in trouble, that eventually they're going to be foreclosed on. Yeah, but that eventuality has a fucking price. And that price today is not what it used to be yesterday. So these fund managers that are purchasing these positions in these notes at...
Wait, let's explain that.
I'm going to explain that. All right. 8%, 9%, 10%, 12%. And then they look at a borrower that's unsophisticated, not understanding that there's a lawyer there that may be sophisticated. And now they're under the gun because this lawyer is not wasting time. They're doing three things. They're creating fucking leverage. That's what you buy when you get a lawyer. Number two, you're making them wait. And you're making them wait for their eventuality, which fucking costs money. And number three, the asset today in its dilapidated condition is only going to be much worse than it's going to be today, than it's going to be in 3 years.
But let's explain that. Let's explain that. So what you're stating, and I agree with you, is the first position that you could take in a distressed asset is to buy the non-performing loan.
Yes.
Which means that the litigation that's occurring on that foreclosure that you are representing the debtor is now they bought it. So they didn't buy an asset, they bought a litigation and a note.
And I'm saying that they did it negligently.
Well, not only negligently, okay. But what you're also stating is if they have an assumption as to when they get to the actual asset. And that assumption, they are borrowing capital, whether it's from these family offices or that capital, at a rate. And their expectation is that they can just wipe it out. What you're saying is that's not necessarily true.
That's not fucking necessarily.
You are creating time and you're creating distance in order to protect the debtor that they have leverage to restructure a deal. I think that's fascinating.
Yes, and the guarantors are in the same position. They're always scared. Oh my God, I'm going to lose my, cross-collateralized property in Hawaii, cross-collateralized property in Alaska, cross-collateralized property in France. So another thing I want to talk about is the corporate poison pill. Let me talk to you about corporate poison pill.
Tell me about the corporate poison pill, Leo.
All right. So let's say, you know what? I'm going to put him on blast. Fuck it. You know Charles Cohen?
Heard of him.
He got clipped for $187 million in million guarantees.
I'm not learning about personal guarantee or personal judgments, I'll tell you that.
And these personal guarantees are a problem, my friend, because let me tell you something.
Wait, when you say a problem, you mean a problem
For the borrower.
not for the lender.
Not for the lender. Now, the lender can do something. The lender, before the judgment is rendered, meaning the judge stamps it, they can freeze the assets. They can freeze the assets of Charles Cohen. And this is public record. Apparently, he has a French chateau, okay? Apparently, he has a yacht, I think 2 yachts. Apparently, he has other assets that they have alleged he has moved. And this guy needs defense. But I think he's a little bit late to the party. I'm going to get a little sophisticated for just 1 second, okay? I'm going to tell you what should have happened and what counsel he should have had and what he should have done. Remember, personal poisoned pill, right? So that presupposes that I have to poison myself to win against my lender. And that's exactly what I'm saying.
Okay.
So allow me to explain.
I will allow you.
Before the judgment came down, he had other value shareholders that had invested with him back 20 years, 30 years.
His friends, his
family,
work of capital.
legitimate transfers of equity. And they, in a great market, were able to securitize themselves. Today, with Fortress going after Charles Cohen, before the judgment was rendered, although the judgment was rendered now, before the judgment was rendered, he can go to these individuals, and those individuals are coming to him. And they're like, what about me? They're going to get a judgment ahead of my interests. I'm sitting in equity. I'm going to lose. I want to be converted. I want to get converted from an equity position
to debt
into a debt position.
And that's because in bankruptcy court, you're stating in the
equity rests below debt. Debt is higher than equity. You know, and some asshole is going to be watching this video who's a lawyer is going to say, well, that's a fraudulent transfer. Well, per debtor-creditor law, and it's fact-based, but per creditor-debtor law, if it is a transfer for an antecedent debt or there was some antecedent consideration and it's fair market value transfer, exchange for exchange, that may be allowed on a case-by-case basis. Anyone that is under siege by a Fortress, a Maverick, a Rialto, and they seem to be losing their Titanic, meaning their asset, they need to engage in what's called the personal poison pill. It simply means that you provide confessions or the equivalent thereof to secure the day ones that have invested with you, the day ones that have nurtured you, right? You don't want them to be out of the money. And I think that's what Charles Cohen, using him as a bright example, should have known or should have been counseled.
I think that's super important. But the bottom line,
right,
is there is a business plan to be executed under distress.
That's correct. And the business plan that I'm discussing, no one seems to know about it.
Now, there's a reason why. And it goes to the other side of what you do, which has a lot to do with psychology and walking people off the ledge. Discomfort makes for poor decision-making. Humans don't like to be uncomfortable. They've been comfortable their entire lives, and now there's discomfort, and they don't really know how to act. And there is a specific strategy that you're stating that you need to implement when you're acting appropriately. But I got a question for you.
Yeah.
The same Fortress, the same credit fund, aren't they sometimes also principals and have the same problem that you're discussing on a different asset elsewhere where they're also foreclosing on a borrower over here?
Yeah, they are.
So they are also experiencing the same issue.
Yeah, but this, what I'm talking about is uncharted territory. Let me paint you the picture, okay? Let me paint you the picture. We had the 2008 financial crisis. We have the savings and loan crisis. Now we have it in the commercial real estate. A.B. Rosen, Michael Fuchs, Shatreats, fucking Charles Brody. Everybody's the shitter. Their value of their real estate is sometimes more than half of its value. And that's not counting their equity that they placed into the property.
Well, that's important because what people don't realize for sponsors and for syndicators is their upside could be capped, but their downside risk is personal. So you only hear in the newspaper and what you're reading is when they're foreclosed. That game just starts when that occurs. They no longer have the value of the asset. They're coming after them.
And I want to flip the script. Just because you're a debt fund, just because you're the one giving out loans, doesn't mean that you can't be a borrower.
Let me tell you something.
Borrowers, even lenders, are borrowers right now.
When you open the Kimono app and look inside, it's the emperor wears no pants. They took out advanced rate debt. That they're intercreditary. They're coming after them, and some of their funds, they're also personal guarantors. That's right. So when you think they're coming after you so aggressively, that's because their ass is on the same line that yours is.
That's never advertised. And that's what I mean when I say confronting the impossible. Thank you so much for joining me today. I appreciate you as always. Thank you for joining us, The Real Deal. To the next show. Thank you.
Goodbye.